Seritage Growth Properties, led by CEO Andrea Olshan, recently released a major update on their planned liquidation. For those that haven't been following along, Seritage is a real estate investment trust in the early to mid stages of a complete liquidation of their real estate assets. Proceeds initially from those sales will be used to repay debt and retire the small amount of preferred stock that Seritage has outstanding, and the balance will be paid out to shareholders as a liquidating cash distribution. Now, initial estimates from that liquidation were a range of $18.50 a share to $29 per share in cash distributions to shareholders. That range has since been revised downwards to a range of $18.50 to $23.75 per share. It's obviously not completely risk-free to go out and sell a bunch of real estate assets, pay off the debt, and hope that there's some cash left over to eventually pay that out to the shareholders at the end. But the shares currently still do trade at a pretty significant discount to that distribution range. So late last week, Seritage announced a 2022 sort of general business update. It included some very good news around the current state of their outstanding debt balances, but it also included some not so great news about some of the prices at which they've been selling properties. So in this video, I want to give you an update of all of the things Seritage had to say in that recent press release. Now, as always, anytime I talk about an individual stock here on the channel like Seritage, in this example, this is not intended to be investment advice in any way. Please do your own work and your own due diligence on this particular stock if you're interested in it. This video isn't intended in any way to make you buy or sell or hold or do whatever you want to do with Seritage. Please do your own work on those things. But this is a company that I've been following for at least a couple of years now on the channel, and I think it's a really interesting example of an initial business. We had a lot of net asset value, hopefully offering some sort of downside protection. They initially wanted to redevelop the portfolio into cash flowing real estate. And the story's changed, and it's the first time I, as a shareholder of Seritage, have been involved in a company that's gone through any sort of liquidation process. And we're kind of seeing that theoretical net asset value that we thought provided some downside protection hopefully materialize into real cash. And for that reason, I think there's a lot that we can learn from following along with that story as it kind of progresses in real time. So if you enjoy this update on Seritage and you haven't subscribed to the channel already, be sure to do so that you can see future content as soon as I upload it. And also check out the Investing with Tom podcast channel. I have Matthew Peterson coming onto the podcast in a couple of weeks as a returning guest. Matt has always been a popular guest on the podcast, and Matt now actually has 1% exposure to the entire Seritage company. Some of that is through owning the shares directly, and some of that is through selling put options, which is a strategy that Matt has talked pretty publicly about as well. So definitely keep an eye out for that upcoming episode with Matt Peterson. Okay, so let's get into this update from Seritage. Now, the major headline, very bit of positive news that will hit you right in the face when you read this press release from Seritage is that they have managed to pay down their term loan to a balance of $800 million. Now, that is very significant for a couple of reasons. One, it means they're producing cash from selling real estate and kind of progressing generally in their liquidation. But that $800 million threshold is really a key milestone for buying Seritage some time. Now, all of Seritage Growth Properties' debt is to Warren Buffett's Berkshire Hathaway. Their initial loan was as much as $1.6 billion. And all of that debt initially, I believe, was due in July 2023. They then managed to negotiate a 2-year extension on that loan to July 2025. But one of the conditions they would have to meet to qualify for that 2-year extension was to get the loan balance down to at least $800 million by July this year. And on the 2nd of February 2023, they managed to get that loan balance down to exactly $800 million, which means they now qualify for that 2-year extension. And they no longer have this very hard and potentially dangerous deadline coming up in only a few months. Now, aside from getting rid of that potential time bomb and clearing the first half of that $1.6 billion of debt that they've now managed to do, it also does result in an annual interest saving. So Just in their 2023 year to date debt repayments, they've paid down $230 million towards that loan, which will save them about $16.1 million in annual interest costs. Those annual interest costs, of course, will be eating into the eventual amount of cash that can be distributed to shareholders, so that's very nice to see. And they also said that after giving effect to the $230 million paydown, the company has in excess of $100 million of cash on hand as of February 2nd, 2023. So they're starting to build a much stronger balance sheet than they've had in the past. And for all the reasons I've just mentioned, as well as some that I'm about to go through shortly with their remaining property portfolio, I think a lot of risk has been kind of backed out of the Seritage situation now. We no longer have that big time bomb. And they've actually managed to clear a lot of the properties that were actually costing them money to own, which I'll talk about that in a sec shortly. But before we do that, let's quickly go through the highlights Seritage have shared from their fourth quarter 2022 and also 2023 year to date property sales and debt repayment and so on. So in terms of their Q4 2022 disposition of properties, they said they generated $332.5 million of gross proceeds from the sale of 24 full assets and 5 partial assets. That looks like it was a mix of both leased out and vacant properties. So for the ones that were leased out, they had cap rates of 7.7%, 6%, and 6.6% respectively. And for the ones that were vacant, it looks like they averaged about $59.74 per square foot or $720 an acre. They also mentioned that on those vacant properties, they will save about $6.5 million annually in carrying costs. So that's what Seritage were having to lay out every year just to own those empty properties. Now, in terms of their 2023 year-to-date sales, they said generated $232.8 million of gross proceeds from the sale of 17 full assets. There's some slightly concerning stuff in here. They said $228.5 million from the sale of stabilized and partially stabilized sites at prices reflecting a blended cap rate of 9.2 and 9.3% respectively, and then $4.3 million of gross proceeds from the sale of vacant or non-income producing assets at prices reflecting on average $21.23 per square foot or $264 per acre. The sale of these assets eliminates $900,000 of annual carrying costs. Now, there's a couple of things that are quite concerning in there. Those cap rates of 9% are exceptionally high. In other words, for every dollar of rent that Seritage were receiving from those properties or net operating income from those properties, they're getting paid very little in terms of the sale price to sell those assets. Now, I don't think you can extrapolate those 9% cap rates across the entire portfolio. As we'll talk about shortly, it looks like Seritage are trying really hard just to clear all of their really low quality properties and hopefully end up with a much higher quality portfolio at the end of this process. But that's something I think we need to just keep a very close eye on. 9.3% is a very low price in terms of a cap rate. We were seeing Seritage sell a lot of properties in like the 5% to even dipping slightly into the 4% cap rate range only a year or so ago. Like I mentioned earlier, in 2023 year to date, they've paid that principal balance down to $800 million as of the 2nd February and had $100 million in cash on hand after making that payment. And the other thing that's really interesting is they said, as we look ahead, we're encouraged by the assets we currently have under contract or subject to accepted offers, which would generate total anticipated gross proceeds of over $580 million if completed. We expect that these transactions, together with the monetization of other assets we have slated for sale, will provide us with the financial flexibility to fund ongoing operating expenses, capital obligations, and further loan paydowns. So they have that loan balance now down to $800 million. They have $580 million in properties that it really looks like are just about to be sold. So that frees up a lot of cash to pay down a very high proportion of the debt that's remaining. Now, for the first time that I've really seen, Seritage in this update actually gave quite a bit of information on their updated projections. Now, they didn't mention anything about their potential distributions. I interpret that to mean as their expectations are unchanged as far as 1850 to 2375. Time will obviously obviously tell if that materializes or not, but they did give some updates on the properties they expect to sell in the next year or two, and the properties in their portfolio they expect to have kind of still remaining there in the next year or two. As you'll see in this graph, portfolio composition by market over time. This is directly from Seritage's update. They expect to have a portfolio that over time will become much more concentrated in what they call gateway markets and primary and secondary markets, and they seem to be selling basically everything that they classify as a tertiary market. So presumably slightly lower quality, less valuable real estate. And as you can see from both that graph and this one, portfolio composition by property type over time, we can actually get a pretty clear indication of how many properties they expect to be able to sell in 2023 and then, what's remaining in 2024 and beyond. And you'll see that they really aggressively cleared what they call the non-core properties. My understanding of those is that they are the ones that really haven't been redeveloped recently, they're often vacant, and they're really the lower value properties in the portfolio, so they are aggressively clearing those, and the portfolio is going to become much more concentrated towards the multi-tenant retail properties, the premier larger properties, and that type of thing. Really, a lot of those lower value non-core properties, the old Sears buildings and so on, seem to be getting culled pretty aggressively. And following a very similar trend, they give some projections here, annual dispositions by transaction size, on what kind of sales they expect to have in 2023 and beyond. And you'll see most of those in 2023 are under $10 million in terms of the transaction size. We've got a few that they expect to be in the $10 to $30 million range, even less in the $30 to $50 million range, and even less in the over $50 million kind of category. But in 2024 and beyond, they expect to have a few properties still in that very kind of upper end of value. So that tells us that probably the last ones to go here are going to be the big premier development sites that are potentially worth well north of $100 million in some cases. So the liquidation thesis kind of does seem to be steadily playing out here. We have Seritage selling a lot of properties, they've repaid a lot of debt, and they've managed to get under that $800 million threshold with a few months yet to spare. And interestingly, they seem to be revealing more and more about their kind of liquidation playbook. They seem to be selling the non-core properties first, typically the ones that are less valuable, are vacant, are perhaps in need of redevelopment work. That probably explains some of the poorer cap rates that we see. And they expect to sell, the more valuable, redeveloped, more leased up kind of properties towards the back end of this liquidation, from what I can tell. Obviously, we'll have to see what happens, but if they end up with a small portfolio of very valuable properties and little to no debt, it may even mean that we finally see some cash flow out of Seritage. We'll have to kind of wait and see what happens in that department, but they're certainly heading in the right direction to have a big change in their underlying cash flows. Now, in terms of a couple of the more negative points that have existed for a long time around Seritage Growth Properties, there's two of them that I think this update really clears up and kind of rebuts pretty nicely. There's a third one that I think is still concerning, and it's a potential, more bearish point on Seritage that is perhaps starting to emerge. Now, in terms of the two that have kind of been shut down, I guess, by Seritage, one is just the looming kind of debt time bomb of July 2023. They're now under that threshold, buys them kind of a couple of years through to July 2025 to clear the last bit of that debt, and they seem to have a good pipeline to hopefully clear that very well ahead of schedule as well. The second thing that often came up when Seritage was talking about doing a liquidation and people were kind of skeptical on it is that Seritage, they thought would sell a lot of their very valuable premier properties, and they would really struggle to sell some of their non-core, less valuable properties. They thought that that would be a real struggle. And Seritage again seemed to be showing that they in fact are able to clear some of those non-core, lower quality properties. In fact, those are the ones that are making up the bulk of the sales. But one trend that definitely is emerging, which is not in Seritage's favor and something we'll have to definitely keep an eye on, is really just a general slowdown in the commercial real estate market, lending getting tougher for prospective buyers of Seritage properties. and just general kind of macro concerns that a lot of companies are talking about at the moment. Seritage did provide some specific commentary on that. They said over the last several months, the company, along with the commercial real estate market as a whole, has experienced progressively more challenging market conditions, especially with respect to larger scale development sites, as a result of, among other things, the continued rise in interest rates, increases to required return hurdles for institutional buyers, availability of debt capital, higher construction and labour costs for development, decreased demand for speculative office development, and slowing rent expectations due to potential recession concerns. These conditions apply downward pressure on all of our assets. The assets we have sold to date have been those less impacted by these adverse market trends, and making decisions regarding whether and when to transact on the company's remaining assets, the company will consider various factors, including but not limited to the breadth of the buyer universe, macroeconomic conditions, the availability and cost of financing, as well as corporate, operating and other capital expenses required to carry the asset. All of these considerations may impact the amounts and timing of distributions to shareholders. So that, I think, is probably the largest risk now at Seritage, is that they end up with a relatively concentrated portfolio of very valuable, high quality assets, but those are potentially the ones that are most impacted by, some of the macroeconomic changes that are going on at the moment, higher interest rates and more difficulty with buyers getting debt to buy these properties and so on. But at the same time, the situation is becoming de-risked in a sense. Seritage is paying down debt, so any movements that happen in those premier property asset values have less effect on the equity. There's less leverage involved in the situation, and Seritage do have a couple of years now to potentially kind of see things stabilize in the real estate market, but we will really just have to wait and see how that plays out. So that is another pretty major update here on Seritage for the beginning of 2023. I do hope you enjoyed the video. Be sure to keep an eye out for the podcast episode with Matthew Peterson over on the Investing with Tom podcast channel. Hopefully that will be out in the next few weeks, and I always enjoy talking to Matt, and he's a pretty popular guest as well, so hopefully people are looking forward to that episode. But that's all I have for this video, and I will see you in the next one. Cheers.